Hello, and welcome to today's Crane Shares webinar, 2025 Outlook, Capturing China's Rebound Through Thematic ETFs. I'm Henry Rees, and I'm based with the Crane Shares team in London. I'll be moderating today's webinar in place of Xiaolin Chen, who is unfortunately unable to join us just at the last minute. We're delighted to have you join us, though, for this webinar, where we'll also be joined by three of our investment specialists from around the globe who will be talking you through the thematic products in our UCITS ETF range that really focus in on the compelling opportunities presented by China and also the global megatrends that China leads the way in. It's a timely moment to be looking at this area with yesterday's announcement from China's Politburo that they would implement more proactive fiscal policies going forward and also moderately loosen monetary policies. As I'm sure you're aware, this has led to a resumption of the rally that was initially spurred by the large-scale stimulus announcements at the end of September, with unprecedented levels of support across the economy, including for real estate, the stock market, and for consumers. There is also the Central Economic Work Conference happening this Wednesday and Thursday in China, and this should give further guidance on government policy and potentially provide further catalysts for the market going into the end of this year and for the start of next. For those of you who, next slide please, Joe. For those of you who are not so familiar with Crane Shares, I know most of you are, but we're a global ETF provider founded in 2013 by Jonathan Crane. We're focused on three pillars: China, the climate, and alternative investments, with fund listings both in the US and over here in Europe. Have the next page, please, Joe. This here is our range of European listed ETFs. Many of you on the call will be familiar with KWEB, our China Internet ETF, and CHIN, our S&P China 500 ETF. We also have recently launched KRBN. That's our Global Carbon Strategy ETC. We've listed it here in Europe on the Italian and German stock exchanges, and that'll soon be live on London as well. This fund offers exposure to a global blend of carbon markets, all in one product. So this afternoon, it's the other three funds we'll be focusing on: K-Star, KSTR, CARS, and K-Green, KGRN. We'll be looking at the macroeconomic and geopolitical factors driving their themes and touch on why you might and how you can integrate them into your portfolios going into 2025. So today we have Derek Yan, who will be discussing the Star Market 50 ETF KSTR. This offers exposure to China's most innovative and rapidly growing technology companies. This is the market often described as the NASDAQ of China. We also have Henry Green, who will speak about the China Clean Technology ETF KGRN, which offers exposure to China's transformative clean energy and green technology industries. These are really the key focus of Xi Jinping's growth plans. And we have Anthony Sassine, who will be looking at the electric vehicles and future mobility ETF CARS. It's a global fund, though it's an area where, as we all know, China is really dominating the world stage. At the end of the session, we'll have time for a live Q&A, so we very much encourage you, please, to submit your questions at any point throughout the webinar, either via the Q&A button at the bottom of the Zoom screen if you're joining us on Zoom, or if you're joining us via our website, please could you just email us at info@craneshares.com. So many thanks again for joining us today. It's our privilege to have you. And let me now hand you over to Derek, who will start us off with an overview of China's Star Market.
Thank you, Henry. Thank everyone for joining today's webinar. So that's a great update. I mean, yesterday's news was really like amazing news. Like I think welcomed by the market. Just like unlike many countries in the world, like United States or in Europe, China never did like a big stimulus package during the COVID, and like over the last 3 years, it's been very challenging macroeconomic. Now finally, like China changed the tone that they want to do more proactive approach on fiscal policy, and they, for the first time since 2011, they changed the tone of monetary policy from stable to moderately loose. So that's very I would say like very like active to really want to do more stimulus to help the economy back. So with that, I think investors globally should like they look at China from the growth perspective, because when you have the economy really transitioning from kind of like a semi-recession in a macro perspective to pick up the growth. The growth sectors represented by tech and innovation and like especially companies in the K-Web and K-Star is really represent the best opportunity. And also from the long-term perspective, I really want to like share some like latest update with you as well that why like China is really transitioning. So looking here, like China, like over the last, I would say, few decades, is really bring like 1 billion people out of poverty, right? Like you have my elder generations, they're working the farm, like in agricultural space. Now they move to the city, this huge urbanization, industrialization. So you know the story that China is really building a manufacturing hub. But just over the last few years, China started to make a more strategic move. They want to really shifting the economy from low-cost manufacturing to innovation and technology-driven economy, right? So by doing that, there's some conditions, right? So instead of like my parents' like generations, like where they don't have much education, but in this generation, there's tons of people going to college, have higher education, studying science, technology, engineers, and mathematics. So there's a huge amount of talents graduated from college with those degrees. And what they do, they put a lot of energies and resources into R&D. So China actually is now leading in R&D spending, and also now is the world leader in the patent application. So a lot of people don't realize that reality, right? So that's a significant increase from previous years in terms of patents compared to many other countries like the United States, Japan, South Korea. So this laid the foundation of China is capable to be an innovative hub, and many companies are doing that job. Going to the next page, you can see that why China is really eager to do that, because there's a huge mismatch, right, between the demand and supply, right? So China is the leading consumption market, probably the most prominent consumption market for technology products, especially for semiconductors. But China can barely supply its own semiconductor industry, right? It's like despite consuming about 40% of global supply, China's only can self-sufficient for like about 12%. So semiconductor is the #1 category for import, right? Even more than the oil. So that's why like China has really a big ambition to really help like fulfill the domestic market, right? A lot of the technology related like companies in downstream, they really need those semiconductors for their final products. So with that, like, I mean, like you definitely noticed that there's an increasing geopolitical tension globally. So everybody wants to achieve a higher level of security in terms of critical technologies. So a lot of companies in China is now making the effort to fulfill that goal for China's strategic goals. In the next page, you can see that the problem for that is that a lot of companies, if they are really innovative, they are in a like earlier stage of growth, they cannot really list the company or IPO the company in China domestically, because the capital market was not reformed before, because there's like a profitability rules. You have to be profitable for 3 years to be eligible to list in the Shanghai and Shenzhen main board. So China realized that problem because all the innovative companies are otherwise going to list overseas in US and Hong Kong. So President Xi made a reform to capital market to really encourage domestic innovative and technology company to go IPO in China, in Shanghai. So that's why like STAR market, known as Science Technology Innovation Board, was established in July 2019 as part of this reform, right? It becomes more flexible. If you don't have profitability for 3 years, you can also be eligible to IPO here because you are really you really want a domestic investor to also participate in the innovation in those companies, tremendous growth opportunity. So what are those companies, right? So in the next page, you can see that the companies listed in the stock markets really focused on the very long-term like technology innovation and critical national goals for China, right? In terms of the industries, in the right-hand side, you can see the pie chart here, like industries including semiconductors, electronic equipment, software, technology hardware, healthcare equipment, etc. Right? So those companies really fall into like very critical long-term themes, including artificial intelligence, high-tech manufacturing, cloud computing, big data, and the internet. Right? Those companies really China need really to achieve those self-sufficient in a lot of critical industries. So like Star 50 index is really the top 50 companies listed in the China star market that we believe is capturing the most critical technology and innovative companies in the domestic market. Going to the next page, you can see like some examples of the K-Star. So by the way, K-Star is the first ETF that invest into the star market outside of China. So CoinShares, we partner with Shanghai Stock Exchange and really be innovative to deliver this access to global investors to those local listed innovative and technology companies. So look at the K-Star's top 10 companies, top 10 holdings. It's really like some companies that's really like very critical and strategic for China. So the top holding, Haigang Information Technology, is a CPU company that provides a solution of x86 CPUs for China. Instead of using Intel's CPU, is very critical for a lot of highly secured solutions, especially in the government and big enterprise sectors, healthcare, finance, you name it. Same as the second company, right? Beijing Kingsoft Software is alternative to Microsoft, right? For especially for a lot of government office and also government-related highly secure sectors, it's extremely important to have an alternative for national security reason. And also a lot of semiconductor-related companies. Number 3, Montage is a memory chip company. Cambercon Technology is an AI chip that's really is China's own AI chip manufacturing and AI chip solution provider for large language model training and inference. Shenzhen Transcend Holdings is a smartphone provider with a huge market in Africa. And Advanced Microfabrication is China's own semiconductor equipment companies. And you also have like healthcare, medical imaging companies. You have smart home solution. You have solar company, industrial automation companies. So those top 10 companies really are really critical for China to achieve this strategic national goals, especially under this geopolitical tension, right? So those top 10 companies account for about even half of the K-Star. So for investors who really want to get access to China's domestic innovation and technology companies. So K-Star is our solution to offer a basket of those companies that solve China's long-term strategic goals, but also those companies has huge addressable markets domestically. There's huge demand for those technology solutions. And now, like because of geopolitical tension, is cutting off from the foreign reliance. So in the next page, you can see that so K-Star, our stock market 50 index uses ETF. It's our solution to really tap into the domestic listed innovation and technology companies in Shanghai. This is really our access solution to the growth factor in China compared to a lot of people may be familiar with K-Web. Is company, the growth company and technology company listed outside of China in the US and Hong Kong, where K-Star is the innovation company listed in Shanghai and majority owned by domestic investors. So those are really two unique solutions that when investors want to look at China growth and innovation technology, those are really like very different solutions for with different investor base and different return profile. So now I'm going to hand it to our colleague Henry Green to have an update on the K-Green.
Hi. Hi, good morning, and good morning from here in New York, and good afternoon to you all joining us from across the pond. My name is Henry Green. I'm an investment strategist here at Crane Shares, and it's my pleasure today to talk to you about the Crane Shares MSCI China Clean Technology Index UCITS ETF. So this ETF, using an MSCI index, is designed to track key themes within China's energy transition. So just to get us started here and think about the size of this opportunity and the size of this major shift in global energy and energy use. China is actually projected to account for almost 60% of new renewable energy capacity, expected to come online by 2028. And it's also expected, the country is expected to have renewable energy account for over 40% of its total electricity consumption as soon as 2027, which we're only 3 years away from. And I would also add here to remember that China accounted for, as of last year, for about 30% of global carbon emissions, which is a massive, massive proportion of global emissions. I mean, basically, when you have the world's factory, you basically end up with a situation where other countries export their own emissions to China, and given that China's, making all of these manufactured goods historically that we all use at home, that's where the emissions have been happening, 30% of them globally. So let's go to the next slide and kind of size up this opportunity, right? So China's energy mix is changing dramatically, okay, and it is likely to look dramatically different by 2060, which is the government's official target to be carbon neutral or have net zero emissions. Key in this transition is phasing out coal. Coal has for a long time accounted for the vast majority of China's electricity production. They've gotten it down to, as of 2023, less than 60% of its energy mix. But a decade ago, this was much higher. This was closer to 80%, 90%. So this is quite a substantial and impressive reduction already. Okay, but even today, China uses over 4 billion tons of coal every year. That's 9 to 10 times what is used in the United States. So they've still got a long way to go in bringing that down. But what's interesting about looking at this theme today is that it was just recently reported by many analysts believing that China has actually already reached peak emissions. Okay, or rather they reached it. They could have reached it last year. There are differing estimates here. And this is interesting because the government's original projection was to reach peak emissions by 2026. So that's moving up the timeline here by 3 years at least. And so, this transition is going to happen where you're moving the sources of energy to these other really the middle three sources here, which are hydroelectric power. China's famous for the Three Gorges Dam, which is one of the largest producers of hydroelectric power. Wind, China is a big producer of wind turbines as well. Solar, China is pretty much undisputedly the world's leader in the production of solar panels, both for their own economy and also for export, and nuclear energy as well, which will be an important part of China's grid going into 2060. Next slide, please. So, using our index as kind of a benchmark for the energy transition in China, right? We see the large majority of the index is composed of energy efficiency and alternative energy. So energy efficiency, when we talk about energy efficiency, we're referring to the actual mechanisms that people are using, whether it's in your home, your car, your office, or industrial processes, and how are those really working to use as little energy as possible and use energy really in the most efficient way. And then alternative energy is focused on the source of the energy, right? Focusing on that it's not coming from coal, that it's not coming from polluting sources, right? And so in alternative energy, you have wind, solar, and nuclear, primarily, also hydropower. So you have companies like Longyuan Power, China Three Gorges Dam, which we've discussed, China Datang. And then in energy efficiency, you have some well-known names like NEO, that's electric vehicles. My colleague Anthony will be speaking on electric vehicles very shortly, tell you more about that. Yadia Group, which they actually make electric scooters, one of the largest electric scooter makers, and CATL, Contemporary Amperex Technology, focused on energy storage, so batteries. They're actually the largest battery maker in the world. And then the last two themes are much smaller, but we do think they deserve a separate category here because they are so different, right? So pollution prevention, that's companies like Conch Venture. Conch Venture has for a long time been focused on kind of waste treatment in China. This has been over the last decade or so has been, a significant theme. Like if you go to China today, it's very clean for the most part, and you don't see that in other developing economies. Are certainly not as clean as China. I was in India recently as well, and the difference is quite stark. And to think that China used to look like that in terms of how clean the streets are, how clean the water is quite exceptional that they've come this far. And then sustainable water is in the same vein. So you have Beijing Enterprises Water Group, and they do a great job of they've done a great job treating water in China and also making sure that it's used sustainably. Let's move to the next slide, please. So then if we go kind of one level deeper, right, we look at, within the energy efficiency area, so that's the green area here on this chart, electric vehicles make up the majority of that. So that's really important, right? So once you have the grid as sustainable, using sustainable renewable power, then also having electric vehicles is very important because if everybody's still using gas-powered cars, then that sort of negates a lot of the emissions saved by changing the grid. But again, my colleague Anthony will have more to say on that. And then cloud services, which is an interesting one. So that's actually technology, cloud, business cloud, everything, cloud data, right? So that's companies like Kingsoft, which is kind of like a Microsoft equivalent. And that's really interesting because a lot of businesses in China aren't actually using the cloud yet. So this is is really important for the energy transition as well for broader environmental conservation, because if you're using the cloud, that means you're using less paper. Or if you're moving your computing power to the cloud, that means that all of that computing and all of that data storage can be managed in a central location. And that benefits from an economy of scale, which also does reduce the amount of energy required to generate that data and computing power. And then, of course, you have batteries. So CATL, one of the most important. And this is really important because the way that we store energy also has an impact on how efficiently we can use it across its life cycle. And then we also have rail. Rail is very interesting in China because, and it's not often talked about, but it is important for the energy transition. It is in terms of long distance travel, it is a more efficient, energy efficient way of getting around. And this is an interesting exposure you can get in China because a lot of these rail companies, some of them are publicly listed, and that's different from in the United States or in Europe, where most of them are run by government agencies. And then, of course, as we've spoken about, we have our energy, alternatives are more sustainable sources of energy. Solar, again, that's solar, hydropower, nuclear, and wind. And then the last two, we have waste treatment and water treatment at 5% and 2% respectively. Just a quick note on nuclear energy. Actually, obviously nuclear energy has been in the news lately, where you have companies Microsoft, Amazon, Google moving to invest heavily in nuclear reactors here in the United States to satisfy in a more sustainable way the massive energy required to run their artificial intelligence, technology. And most likely companies in China are going to come to a similar realization. So that's important to have also exposure to in this fund. And China actually currently has the most nuclear reactors, 22 reactors under construction, which is actually the most of any country globally. So that's a really interesting theme in China that it doesn't get talked about a lot. If we move to the next slide, please, we have just some more examples of companies within these themes, right? So energy efficiency, mostly electric vehicles. We have NIO, which again, Anthony will speak more about electric vehicles, and then alternative energy. So CGN Power, which is China General Nuclear. That's actually the third largest nuclear power company in the world and the largest reactor company in China, with the largest fleet under construction as well. Pollution prevention, we have China Conch Venture, large-scale enterprise group providing a variety of solutions for energy conservation, environmental protection, mostly focused on, again, waste treatment, right? And sustainable water with Beijing Enterprises Water Group. So the last two themes kind of act more like utilities, whereas the first two, in terms of investments, right, are more kind of growth oriented, right? So really, you know, in this fund, in this theme, you kind of do get a little bit of that barbell. Obviously, the utilities representing a much smaller portion, but you do kind of get that barbell in terms of your factor exposure, which is interesting. Let's move on to the next slide, where just kind of going over what happened in 2024 over the past year. Obviously, the year's not over yet, but we're getting close. And so these companies have actually performed pretty well, especially when you think of, you know, all the volatility that's been in the China space recently. You know, over the past year, actually, the water treatment companies have performed the best, which is interesting. And I think that's, again, these are kind of utility names, and I think that's come off of, you know, better expectations for the economy, where they're going to kind of see better revenues, better collection, a collection of their accounts receivable. And then cloud, you know, obviously was part of that technology and internet, significant rebounding one of the most out of the sectors in China, you know, on that stimulus announcement we had back in September. And then solar. So solar hasn't been doing quite as well, and in terms of share price return, and that's really because a lot of the solar companies are the most exposed to the external demand. So they're exporting so much to the United States and Europe and other countries that they're really sensitive to potential protectionism in these economies, right? And so, you know, there's been a lot of volatility stemming from this factor. Our view is that most likely you're going to see some kind of deal making, especially with a new Trump administration in the United States, that may lessen the blow and may, you know, create kind of a better understanding between, you know, these companies in China and where they're exporting to. We know that European leaders have been in talks on the electric vehicles front, and also on solar panels. So that's really positive. But that did hurt solar names over the past year. And then revenue growth, interestingly, rail companies saw the best revenue growth in 2023. And I think that's because, you know, Chinese consumers have been traveling. That's where the bulk of their money was spent in 2023, and even into 2024. So I think that's an extension of that. You know, Chinese consumer, they love to take rail everywhere. They have vast high-speed rail networks, can pretty much get you anywhere. Electric vehicles also doing well. You know, we've seen they extended the tax subsidy. But again, my colleague Anthony will get more into that. And then we also have solar still doing well, still, you know, the big export market, continuing demand worldwide. Obviously, you know, there are risks there, given, you know, the protectionist stance of many countries to which it's being exported. And maybe let's go to the next slide now, just to look at the kind of fund's performance year to date here. So this is looking at the fund versus the S&P Global Clean Energy Index, which is mostly focused on the energy side of things, but it is both developed and emerging markets. So we do think it is somewhat of a relevant comparison. So as you see, you know, in late September, when the government central bank came out with some unprecedented stimulus announcements, including real commitment to stock market stabilization fund, rate cuts, lowering down payment minimums for real estate, and just a whole slew of stimulus policies, really, lifted, as a rising tide lifts all boats, right? So lifted equities, and that includes, of course, the companies that we hold in KGRN. And then you kind of see a pullback there significantly from the high. There was a lot of exuberance there on the stimulus announcement. And then we see kind of what we believe is another little uptrend here. And then meanwhile, I think with the United States election in November, you see kind of the global clean technology index coming down a little bit on expectations on people, wondering if there's a little uncertainty with a new U.S. administration on what the energy transition policy will be. Meanwhile, the China names, China Clean Technology, represented by KGRN, are still up about 5% for the year so far. And next slide, we have just looking at some multiples to kind of get an idea of how these companies are being valued. So of course, interestingly, right, KGRN is still seeing a lower multiple. That's earnings multiple compared to global clean energy, which is interesting given that its performance has actually been better this year. And that's again stemming from, on the right, where you have pretty positive EPS growth expectations. And these are also very positive compared to broader China benchmarks, looking at MSCI China and even MSCI China All Shares. All Shares is more relevant because KGRN has both A shares, H shares, and US listings. It has all three. But again, even though we think that some of these EPS expectations for the broader China equity space and broader Chinese companies are likely to be revised up with the stimulus announcements. Nonetheless, the companies in KGRN are expected to grow EPS by a pretty healthy 14% annualized in 3 to 5 years. So, and now I think I would like to pass things on to my colleague Anthony. Just quickly, right, we have this is kind of an overview of the KGRN UCITS ETF listed in London with top 10 holdings. And so Anthony will now speak on our Crane Shares Global Electric Vehicles and Future Mobility ETF. Anthony, take it away. It's a moment we've been
That's
waiting.
great, Henry. Can I just jump in very quickly here just to remind people that are streaming this webinar, if you want to ask questions via the email, that would be info@craneshares.com. We're getting a good few questions over the Zoom link, but for those of you that are streaming, you need to use info@craneshares.com. Sorry, Anthony, for interrupting there. Just thought I'd jump in with that quickly.
No, thank you so much, Henry. Appreciate it. Good afternoon, everybody. My name is Anthony Seen, and I'm a senior investment strategist at CraneShare, focused on China and EVs. And just kind of as a continuation, what we've been hearing from Henry and Derek, that the rebound in China, seems more likely every day, especially with governments rolling out more stimulus starting in September and October, and then the recent meeting that we saw a couple of days ago, which will be followed by another with the CEWC in the next 2 days, kind of confirms China's support for consumption. What does that mean is more consumption for cars, for EVs, for renewable energy, for all the themes that we're talking about today. And this is kind of the best way to play that rebound. And we've seen some of these policies take effect over the past few months. China has implemented some very rigorous trade-in stimulus policies, especially for cars and appliances. And we've seen these two industries grow in a big way, 3-4 months in a row, hitting high watermarks or record numbers of sale in a row, which is very indicative of how responsive China's consumers are to Chinese policies when they happen. And I think 2025 is going to be the year of the consumer in China, where more policies to support consumption is going to be implemented, especially if China is seeing more risks on external risks, especially from the US concerns to tariffs, which could hit exports. So China's getaway here is to lift consumption. So we're talking today about electric vehicles, which is more of a global fund, but a big chunk of it is coming from China. China is the heart of the electric vehicle industry in the world. And we have a very nice fund that we built with BNF, Bloomberg New Energy Finance, that kind of captures that industry well. It's a comprehensive exposure to the electric vehicle, covering multiple industries. Next slide, please. And multiple sectors within that industry. So basically, when we got together with BNF, we said, we want a fund that captures every single business and industry that benefits from the sale of electric vehicles. And that's how we came up with these different sectors, including electric vehicles themselves, and then the components or the sensors, the seats that go into the electric vehicles. Also, the batteries is a big part, 30 to 40% of the cost of the EV, and an integral part in terms of lowering the cost of electric vehicles to hit ICE parity. We also cover communication, autonomous driving, charging infrastructure, and of course, raw materials such as lithium, nickel, and all the metals that go into the batteries. Next slide, please. So basically, it's a huge investment opportunity, right? Whether when you talk about climate, when you talk about energy transition, our globe is going through a major transition on multiple levels, and transportation is one of the major parts of this. We have currently, I think, 1.4 billion cars globally, and we have to switch those to electric vehicles. And you see in this slide the amount of investments that keeps going into these sectors. And BNF expects electric vehicles to be $200 trillion. Actually, the energy transition to be a $200 trillion investment opportunity over the next 30, 40 years, where electric vehicles is close to 60 to 70 trillion, which is a massive investment opportunity. When we talk about a $1 trillion opportunity, we're all ears. Now we're talking about 60 and 200. So this is something that investors definitely want to be exposed to, especially for the long term. Next slide, please. As I mentioned, there's 1.3 billion now cars globally, and only 40 million by the end of this year probably will be electric vehicles. So there's a long way to go. And if you look at the left, China is leading the way, with the EU close second. The US made a lot of progress over the past 2 years, but I think it could stall a little bit behind in the next few years as we see potentially the new administration repeal some of the IRA policy that the US came up with 2 years ago, especially subsidies for EVs. Next slide, please. So as I mentioned, the goal here is to hit ICE parity, and ICE parity means that when you go to a dealership and you see the same car in an EV powertrain or a gas powertrain, you're going to see the EV cheaper, cooler, and faster. And this is where we predict we're going to hit mass adoption. This is where we're going to see the second wave of growth. The first wave of growth started with COVID, potentially 2019, 2020, where we saw electric vehicles sales go from 2 million to 60 million per year. And then that kind of stalled a little bit over the past year because of economic hardship in multiple places, because of also cars not being cheap enough. And I think the next wave of growth is going to come. It's going to be bigger, and that's going to hit when we hit ICE parity, and we're not too far from that. This year, actually, we made a lot of progress towards ICE parity, more than projected, mainly because of the cheaper batteries, mainly because of lower lithium technological advances and competition. Also, that kind of lowered the prices quite a bit, and now ICE parity is pushed actually forward. Instead of being in 2027, now we're expecting it to be 2026 for multiple models in multiple countries. Next slide, please. So basically, EV sales had an inflection point in 2018, 2019. A lot of it has been driven by China. This year, we're expecting 16 million cars sold, which is an increase from almost 14 million last year. A lot of those cars are going to be sold in China, over 10 million of those. And a lot of those are some of the companies that are included in the cars fund, like BYD. Tesla is also selling in China. Geely, NIO, Xpeng, and many Li Auto, and many of these companies. Next slide, please. So as you can see, this is the EV ecosystem that we talk about. You know, these are the companies that contribute to the production of an electric vehicles, and also to the operational part of the electric vehicles, that's the charging. So all these companies are covered in the fund, and if you can see on the very right, we're adding some of the semiconductor companies that are involved in that space, Infineon and Aptiv. This fund does not include NVIDIA or some of the big semiconductors, which have a small business to electric vehicles, but a lot of the revenues are driven by AI or driven by gaming and other factors, right? So the semiconductor companies we have in this fund are very specific to electric vehicles, and this is very good for investors, because as you invest in electric vehicles, you don't want to be adding risk on risk, because NVIDIA, Google, some of these companies are actually owned by probably multiple funds in your portfolio. Here we make sure that we don't include the companies that are not involved in EVs. Next slide, please. So basically, when you look at the fund very specifically, we're all the way on the left. This is the CraneShares fund that tracks the Bloomberg Electric Vehicle and Future Mobility. And then in the middle is the Selective Autonomous Electric Vehicle Index. Also, it is a popular fund or popular index. And then the NYSE FactSet Global Autonomous Driving and Electric Vehicle Index. You see the dark blue is here what these are the sectors or industries or companies that have majority of the revenues coming from electric vehicles, and the light blue are actual companies that may have some business in electric vehicles, but their majority of the revenue is influenced by somebody else. And as you can see in the middle, big semiconductors or big tech like NVIDIA, like Texas Instrument, like Google, and Apple. So these are companies that may have some business in that space. Google through Waymo, which is less than 1% of its revenue, but 99% of its revenue is coming from something else. So these are excluded. That gives our fund, basically a very high correlation to electric vehicles and a lower correlation to S&P 500 or some of the other funds that may own these big technology popular stocks. Next slide, please. And also, when you build an electric vehicle fund that is well done, that you lower the correlation with other major indices like the ACME. Cars has less than 1.72% overlap with ACME. That's most of it is Tesla and probably in BYD. But that's a good news for you, because that lowers the correlation of that fund and give you a differentiated source of alpha. Next slide. So basically, the electric vehicle industry is a huge opportunity for investors. Very long-term growth. As I said, 1.2 billion cars have to become, electric vehicles. So that's a lot of sales for some of the companies. And now we're starting to see a big differentiation in these companies, where it's becoming harder and harder to enter the EV industry, and you have 4, 5, or 6 companies kind of dominating that space, whether in the EV sector or the battery sector or even the raw materials. Many of these companies are becoming leaders. So I think what we're looking for in next year or so that could jumpstart the EV sector again is cheaper electric vehicles, which we started seeing more EV electric vehicle companies rolling out, like NIO just rolled out the Envo, which is 30% cheaper. Also, Xpeng is working on a car. BYD has been very popular because of its cheapness. It's been cheap all along, and also they had plug-in hybrids. Li Auto now also came out with the L6, which is also on the cheaper side. And if you look at their sales today, hitting record highs, and a lot of it is coming from L6. Also, now we're waiting for Tesla. One of my opinion is Tesla is at a disadvantage today, despite its stock hitting all-time high. from a fundamental perspective, I look at Tesla and I think about the next year or two, the growth of the next year or two without a cheap car, which they said it should be coming in 2025. So cheaper car is essential. Cheaper batteries are essential. Continued government policy, especially from China, and hopefully less protectionism globally, so we can, so cars and consumers can get their hands on the cheapest products possible, which could be coming from China, such as batteries or raw materials. But one way or another, we're all gonna own an electric vehicle at some point, and having an investment in that space is essential for the long term. It gives you exposure to a long-term growth story and also a differentiated alpha source that could be less sensitive to global cycles, normal global macro cycles, right? Extreme rates could be damaging, but a normal interest rate cycle should be less damaging for a long-term secular growth theme like electric vehicles. Thank you, and please let us know if you have any questions. We're happy to answer them.
That's great. Thank you very much indeed, all three of you. And we do have some questions coming in. I think what I'd like to just state at this point as well, that in relation to Anthony's fund, their cars, KRS, that's under SFDR, that's an Article 8 fund. It has an ESG screening. So if that's a consideration to anyone's portfolios out there, that's Article 8, as is the fund that Henry spoke about, KGRN, K Green, the clean tech, China clean technology. That is also an Article 8 fund under SFDR. So thank you very much again for those presentations. I suppose tackling these sort of questions, and thank you very much for them. Please do keep sending them in chronological order. Simon sent one in earlier on for you, Derek. Obviously, there was this rally in China on the back of further positive news from the government. Simon's saying it sort of retraced a bit the next day. His question is, why do you think the Chinese market sold the ADR rally yesterday? Is that institutional investors looking for the exits? That's his question to you, Derek.
Well, yeah, thank you for the question. I mean, the rally yesterday was huge, right? So definitely there's some investor take profit today. That's pretty normal as a little pullback from the big rally. But just like in terms like we're high level, like institutional investor, they're so on their own, right? Like talk about like China's economic and stock market cycle, right? Like you have a huge stimulus in the US and Europe during the COVID, and then you have this inflation cycle outside of China. Then in China, there's no stimulus, then there's deflation cycle. Now with those coming up stimulus, you're gonna see this is probably a tipping point for the economy and the stock market cycle, where the institutional investor just starting to allocate money to China, right? We have heard from many institutional globally that they're increasing their interest and allocation to China. So this is more like medium to long term, I think, allocation. But just like in the very short term, definitely you have some like a rally and some take profit, but like you do see those people trading around the news. So that's pretty normal for the short term.
And if I may add here, look, investors are taking notice of China's adamant support for growth, starting with the big bazooka that we saw coming in October, September, and now we're seeing the strongest language for consumption support. So as an investor, you cannot afford not to be exposed to this and miss the upside. So investors are kind of taking notice, but also investors want to see more concrete steps and want to see these steps translate into earnings growth. So that's going to be your next step of growth, where you're going to start seeing more institutional clients come in. But everybody's watching and everybody's worried about missing the upside, especially knowing that China wants to make it happen and they have the tools and resources to make it happen.
Yeah, thank you, guys. And then next question is another quick one for you, Derek, around KSTR and its holdings and how it handles the US sanctions list. And do you know if other asset managers how they handle similar situations and if that differs from our approach at Crane Shares.
Yeah, so for CoinShares, we are the U.S. asset manager, so we have to comply with the U.S. regulations and sanction list. So we don't hold any companies that is in the U.S. sanction list in K-Star. But like I think like generally the impact for a sanction to those companies are pretty limited because the majority of the shareholder and owners is really domestic investors for those companies. So like I don't think that they're like as a U.S. asset manager like CoinShares, we do not hold those sanction lists, but like I think that general impact on terms like shareholder is more limited.
Yeah. So we remove them from our fund, but perhaps other people may leave them in, but we can't speak for their approach. Here's an interesting one that's just come in over Zoom. We look at, as I mentioned at the start, probably everyone is familiar with our China Internet ETF KWEB that holds a lot of the names at the heart of the China growth story. And so how do these other themes, the question is, how do these other themes balance with KWEB? Is there much overlap between these funds and KWEB itself? And how, I guess, and then another further question would be like, how might you think about blending these funds with a holding in KWEB? I don't know. Henry, do you want to kick off on that one? Or?
Yeah, sure. The funds we talked about today, very little overlap. I can think of for KGRN, Kingsoft Cloud is also in KWEB. I think that's the only company I can think of that would be in both. Similarly for Cars. Well, Cars is also global companies, not just China. KRS, I mean, and for Starboard is mainland China listings. So KWEB is only Hong Kong and US, which are known as the overseas names. So there's no overlap or potential for overlap there. With our other funds available in UCITS, CHIN, there is some overlap there just because that's such a broad set of companies across, the larger caps across all the listing locations. When I think about an allocation to China, I would think that, I think KWEB is representative, kind of more, so to speak, mature companies, and it's more of a mature theme. I think that the other themes we're talking about here, whether it's Star Market with technology innovations or KGRN, I think with those two, those are kind of more emerging themes. So I think that KWEB should be considered kind of while it is thematic, I would kind of consider KWEB nowadays as being kind of a core as well, just because these companies in KWEB represent such an important, really the transmission engines of China's consumer economy, which is really important going forward. And then KGRN, KSDR are nice complements and should have relatively low correlations to KWEB. But KWEB, I think, is more closer to China core. I don't know if anybody else has anything to add.
Yeah, I want to say like K-Star, you think like NASDAQ for China, but like combining KWEB and K-Star is truly the NASDAQ of China, right? So you have like e-commerce giant Alibaba and social media advertisement, like those businesses really like should be in the NASDAQ, right? But like a lot of companies in the semiconductors, like CPUs, AI chip, those automation companies, those are really important for a growth portfolio, right? So when you want to invest in China growth, when you want to tap into like a more like NASDAQ approach to China, I would say combining KWEB and K-Star is like a complete set of the growth company and innovation company for China's technology exposure.
Yeah, super. Thank you. And Anthony, you obviously handle our models in the US. What are your views on how you can blend these different funds into your portfolio?
Yeah, no, all great funds. And the way we do ETFs here at CraneShares is we focus on the long-term story and the future of these themes, and we only build ETFs around themes that we know that they're gonna grow for the next 10, 15, 20 years, long-term stories. And if you look at the communique that came from the meeting 2 days ago, all these themes were mentioned, right? Green technology, consumption, real estate, right? So all these themes were mentioned as focus by the government. And obviously the big one is KWeb, and it will have the highest beta to any upside. And plus it has some of the most resilient companies that are involved in multiple sectors, whether AI or e-commerce or social media or gaming through Tencent, Alibaba, Meituan. This is the broadest exposure you can get to the Chinese economy, but also you don't want to forget about the clean tech company and the other the A-share company, specifically through KBA, which is not mentioned here, which also represents a great basket of stocks that are involved in healthcare, consumption, renewable energy, manufacturing.
Yeah, just for our UCITS viewers, so CHIN is our kind of A-shares representative. It's overweight to A-shares in the UCITS space. KBA is available on in the New York Stock Exchange as a US ETF. I think we also have a question about, and that leads into, if you don't mind, Henry, we have another question, just somebody asking what core China portfolio positions we offer. So in UCITS, again, that's going to be CHIN, which is S&P China 500. That's really the China core, and then KWeb is thematic, but as we've discussed, represents such an important part of the economy in China. It could be considered close to core.
Do you want to show
Henry, I
the
think
page
it'd be nice to
three
say
of the,
about Chin. Sorry.
do you want to show the page 3 of the deck? I think you did it like maybe you want to like show the people our own product offering. Yep, here's the page. Sorry to interrupt.
Yeah.
Yeah, and just on in terms of thinking about allocation, I think right now, because you're seeing such massive broad moves with these stimulus announcements, I think the correlations between these themes and the themes and core China, CHIN, are quite high right now. And then I think we're gonna, as we continue, as the re-rating plays itself out, after it plays itself out, I think we're going to see more differentiation. But right now, you're seeing quite high correlations just because of the strong moves in the broad market.
And I think it's worth pointing out about CHIN, isn't it, Henry, at this point, that as it follows the S&P China 500 index as opposed to the MSCI or China index, it includes the A-shares stocks at their full weighting, full market cap weighting, which means it's got a much higher concentration of A-shares funds compared to the MSCI equivalents at over 60% A-shares. So that's quite a key differentiating factor that makes this, very much more attractive and representative of the true sort of China economy that it tracks than other indices.
Yeah, absolutely. A-shares represent about 50% of China's total market cap, equity market opportunity. Whereas, if you think of MSCI China Index, which is a popular one, I mentioned it in my slides, that's only going to have about 20% max to A-shares. So that is a big advantage, we think, of CHIN.
So we will have clients that may blend sort of KWeb with CHIN, and then maybe introduce K-Star as a bit more sort of mainland growth style stocks in there. But yeah, you can blend all these different themes to make sure that you're getting access to all the best parts of the Chinese growth story going forward. And all presentations for all these funds are available on our European website, craneshares.eu. If you went to craneshares.com, that's got all our US listings. But then for our UCITS range, if you're interested in UCITS products, it's www.craneshares.eu. And all the presentations are there, all the fact sheets, and other webinars and reports that we've done in the past. So, please do, it's free to access. So please do go on to our website and use everything that we have as you require. and get in touch with us if you have any questions at all. So, I don't, is there? We're approaching the hour now. I don't know. Do any of you three? Is there anything you'd like to add? Any last points as we head towards the end of the year and look forward to 2025?
Yeah, I can end. So basically, look, we do a lot of research on China. We speak with companies, policymakers on a daily basis. We've been followers of China for a long time, and what we're seeing today is a big shift from government in terms of handling its economy. And where over the past 2 years it's been conservative in terms of rolling out stimulus. Now, stimulus is being rolled out in a big way, whether supply side, and now we're seeing demand side. And investors kind of took notice of what happened over September, October, where some of these funds were up 40-50% in a short period of time, and realized the power of how the government can change sentiment. And I think 2025 could be the year of the consumer, where China is going to be focused on that. A lot of the themes that we discussed today are going to be big beneficiaries of these policies. And I would look at consumer sentiment, earnings, more policies towards consumption to kind of get the signal where China's moving to a second gear or third gear in terms of recovery.
Yeah, I want to add, like, if you invest in US, listen to Fed, right? Like, if you invest in China, like, listen to Politburo meetings. Like, those are decision makers in monetary and physical policy. So, like, now decision maker told you so. I mean, that's kind of like most important thing to watch for the tactical allocation. So yeah, just if you have those like policies coming up, I think investors should really consider a China allocation.
That's super. Thank you very much indeed. Joe, could you just put up the contact slide at the end there, please? And I'll just very quickly to wrap up. And thank you very much indeed, everyone, again for joining us. You'll see at the bottom right of that page there a couple of links to China last night. Now that's our CIO Brendan Ahern's daily blog on the China markets. It's free for you to subscribe to. So if you'd be interested in that, please do go and subscribe to that. I know many of you are already. And there's also China Climate Market Now, which is our climate market blog that Luke Oliver and his team based in New York do to keep you up to date with all the developments in that industry as well. So there's some resources there for you all freely to use. And otherwise, just say, please do get in touch if you have any questions at all. And thank you very much indeed for joining us today.